Hi CA students, let's revise CA Final AFM Chapter 13 Business Valuation. Illustration 1. There is a privately held company X Private Limited that is operating into the retail space and is now scouting for angel investors. So, angel investors are those individuals who provide capital to startup companies in exchange for equity ownership or some equity kind of investment in the company. And these people mostly invest in the early stage of investment when the company is in the startup phase or in the seed stage. So here X Private Limited company also is going for angel investors as they require funds. The details pertaining to valuing X Private Limited are as follows. So in the general scenarios, to the angel investors, when we are seeking money, we will be showing the valuation of the company, of our company, and giving them the like credibility or giving them the viability of the business. That's the main motto. So valuation plays a major role in that. So here also, since they are scouting for angel investors, X Private Limited is it requires a valuation, business valuation, to be shown to the investors. The company has achieved break even this year and has an EBITDA of 90. So break even is nothing but when your expenses and when your income meets your expenses. As we know, during the startup phase, most of the companies, almost all the companies will burn money, and they will achieve break even. So when their complete expenses meets the revenue, which signifies they are generating enough revenue to meet their complete expenses, and has an EBITDA of 90. So EBITDA is nothing but earnings before interest, taxes, depreciation, and amortization. So why EBITDA? Because it shows the operating profit of the company before deducting those interest on loans, taxes, and then cost like wear and tear on the assets. Nothing but the depreciation and amortization. It gives a clear picture of business performance without the effects of this financing and then accounting methodologies and all. So it's give the viability of the income stream. The unlevered beta based on the industry in which it operates is 1.8. So beta is nothing but the sensitivity of the like the stock or in here it is the case of the company towards the industry standards. So that's what beta signifies towards the industry markets. Unlevered beta is nothing but the equity portion of the company based on the industry's terms. It will not include the debt portion of the company because it depends to company, right? So the unlevered beta will give us the idea of the industry's risk, not influenced by the company's individual the individual company's debt. And the average debt to equity ratio is hovering at 40 is to 60 percentage. So 60 percentage is funded by equity, and then 40 percentage is funded by debt for X Private Limited. The rate of return provided by risk-free liquid bonds is 5 percentage. The EV is to be taken at multiple of 5 on EBITDA. So what is this EV? EV is nothing but the enterprise value of a firm, and it is taken to be a multiple of 5 on EBITDA, they are telling. So enterprise value is the total value of business, which includes debt also, and then excluding the cash element. Now this method assumes the business in the same industry sells for similar multiple of EBITDA. So that's what is the assumption. Let's say here the X Limited is into the retail space. What if some other company is in retail space and for if the company is sold for this much amount, like 5 multiples of EBITDA. So that's what this enterprise value will give. It will give the investors a base for comparison. So that's what this enterprise value. So if we found out enterprise value, and then we can compare with the industry standards. That's what enterprise value will help us. The accountant has informed that the EBITDA of 90 includes an extraordinary gain of 10 for the year, and a potential write-off of preliminary sales promotion cost of 20 are still pending. So what they are trying to tell is, EBITDA, as we have previously discussed, EBITDA gives us the viability of revenue generating capacity of the company. So it should be in the regular terms, and it should not include any extraordinary items. In this given case, extraordinary gain of 10 is there, and then potential write-off of promotional expenses is there. Hence this 2 has to be eliminated from this 90 to arrive at the adjusted EBITDA, which will give us the base for the viability of like revenue generating capacity. Now the internal assessment of rate of market return for the industry is 11 percentage. So risk return on rate of market return is 11 percentage. The FCF is nothing but free cash flows for the next years are as follows. They've given free cash flows for 3 years. The pre-tax cost of debt is 12 percentage, and assume a tax regime of 30 percentage. To tax rate is given, and then cost of debt is 12 percentage. What is the potential value to be placed on X Private Limited? So they are asking the value of the firm. That's what they are telling. Potential value to be placed on X Limited. Here there are two ways of calculating the potential value. So one is using this enterprise value method. So wherein we will be taking the adjusted EBITDA and then multiplied by the uh, multiple we have. So as we have seen, 90 is the EBITDA. Then we will be reducing the extraordinary gain, and then we will be reducing the write-off of that preliminary sales promotion cost 20. So which will give us 60 multiplied by 5 will give us the enterprise value, which is nothing but 300 in our case. So this is one value. This is one method of calculating the value of the firm. And the second one is discounting the future cash flows, that future cash flows with this, that free cash flows to firm with the weighted average cost of capital. So discounting it at the weighted average cost of capital will give us the value of firm. So how will we calculate weighted average cost of capital? So it will be nothing but cost of equity plus cost of debt. And cost of debt, we know that it is 12 percentage, and then we have to adjust it by the tax rate and then ratios. So a general formula would be KE multiplied by E by E plus D plus KD multiplied by D by E plus D, wherein E plus D is the equity plus dividend, and E is the equity portion of the fund, then D is the dividend portion, then the cost of KD is nothing but the cost of debt, KE is nothing but the cost of equity. Here cost of debt is after adjusting the tax rate. So pre-tax rate is 12 percentage, so 12 1 minus tax rate, which is 30 percentage, will give us, so 8.4 is the KD. Then KE how we'll find out? Since we have rate of market return and then risk-free return, so we can use CAPM model, but we need beta value. We know the unlevered beta, we need levered beta, because that will be for the which will include firm's debt portion also. If the firm doesn't have any debt, then unlevered beta will be equal to levered beta as there is no debt portion. But in the given case 40 is to 60 is the ratio of debt is to equity ratio, hence we have to give adjustment to that. So how will we do that? As we know, this 1.8 unlevered beta is for the equity portion, so dividing it by 60 and then multiplying it by 40 will give us the debt portion. But as we know that tax rate is there, so tax adjustment also has to be done to the extent of 30 percentage. So 1.8 minus 30 percentage divided by 60 multiplied by 40 will be 0.84. This will be the debt portion of beta. Now adding it with the equity portion will give us the total beta. So 0.84 plus 1.8 will give us 2.64. So 2.64 is the levered beta of the company. That's what they have also found out using the formula. So the formula will be nothing but unlevered beta multiplied by 1 plus 1 minus tax rate multiplied by debt equity ratio. That's it. So 2.64, using this we can apply in the CAPM formula and then find out the cost of equity. In our case it is 20.84. Now 20.84 if we apply in our weighted average cost of capital formula, so K is 20.84 multiplied by 60 divided by 100 plus 8.4 is what post tax cost of debt multiplied by 40 by 100 will give us the weighted average cost of capital, nothing but 15.864. Now if we discount the future cash flows in this rate, then we will get the present value of cash flows. Then total of all the present value of cash flows is nothing but the value of the firm. That's it. So the enterprise value is 300 and the value of firm using this weighted average is 272.15. Thank you.